Have you ever wondered why 90% of traders consistently lose money in the markets, despite having access to the same information, tools, and platforms as the professionals? What if I told you that the most powerful trading strategy isn't found in complex algorithms or obscure technical indicators, but in something you already possess, yet rarely use? In the collective imagination, the world of stock market speculation is portrayed as a battlefield of frantic energy and chaos. We've all seen those. Hollywood scenes, traders frantically shouting across the floor, screens flashing red and green, fortunes made and lost in mere seconds. Has this ever happened to you? You watch financial news, see markets moving, and feel that gnawing anxiety that you're missing out on potential profits every minute you're not in the game. This dramatic picture has programmed novice traders into believing that success comes from perpetual activity, always buying, always selling, always doing something. It's the trading equivalent of constantly changing lanes in heavy traffic, convinced that movement, any movement, equals progress. But what if everything you've been taught about successful trading is fundamentally wrong? Jesse Livermore, one of the greatest market operators who ever lived, discovered a profound truth after 45 years of active trading. The greatest secret to trading success isn't found in constant action, but in its polar opposite: strategic, unwavering patience. Stay with me until the end of this video series, because what you're about to discover might completely transform your approach to the markets. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Livermore taught that patience isn't a passive virtue, where you simply sit on your hands. Rather, it's an active and powerful weapon in the trader's arsenal. Through meticulous study of market behavior, he observed something remarkable. The vast majority of losses suffered by the public weren't the result of poor analysis or flawed methods. They stemmed directly from one fatal mistake: trading too frequently without waiting for definite rule-based signals. The average trader, Livermore noted, enters the market not because clear rules have given them a signal, but because they're driven by the destructive emotions of hope, fear, and most devastating of all, impatience. They hope for quick profits, fear missing out on moves, and lack the discipline to wait for genuine opportunities. Think about your own trading for a moment. How often have you jumped into a position simply because you felt anxious watching from the sidelines? How many times have those impulsive trades worked out in your favor? What makes Livermore's approach so revolutionary is that it inverts everything we think we know about successful trading. While most believe that making money requires constant engagement with the market, he discovered that true wealth comes to those who master the art of waiting. The question isn't whether you should be patient, it's understanding exactly what you're waiting for. If you want to master the art of patient trading like Jesse Livermore, hit subscribe now. I'm sharing these timeless market insights that transformed my own trading journey, and they might just transform yours too. What Livermore discovered through decades of market observation was a hidden truth that many traders still fail to grasp today. Overtrading is the single greatest evil in Wall Street. This isn't just a minor misstep in an otherwise sound strategy. It's the fundamental reason why most trading accounts eventually collapse. The journey toward mastery begins with understanding this psychological trap. When we sit on the sidelines, watching the market move without us, a peculiar form of anxiety takes hold. It's a restlessness that whispers, "You're missing out. Everyone else is making money while you're doing nothing." This internal discomfort creates a powerful illusion that being in the market, regardless of conditions, is better than being out of it. This mindset transformation doesn't happen overnight. The unprepared trader genuinely believes that if they're not actively trading, they're not really a trader at all. Their identity becomes wrapped up in constant action rather than thoughtful decision-making. But behind the scenes of every successful trading career lies a counterintuitive revelation. Sometimes the most powerful position is no position at all. Now, I want to go even deeper into this topic by examining the cold, hard mathematics that Livermore uncovered, numbers that expose why impatience is not just psychologically damaging, but financially devastating. Consider two traders with equal skill at analyzing markets. The first is an impatient scalper who makes just one trade every market day. Over a year, that's approximately 300 trades, each complete round trip, accounting for commissions, taxes, and the bid-ask spread, costs this trader at least half a point. On a 100-share trade, this creates a 150-point handicap annually before any actual trading gains or losses. The second trader, the patient professional, makes only one trade per month, totaling just 12 trades per year. Their annual trading costs amount to a mere 6 points. This creates a staggering 144-point advantage for the patient trader before either has even looked at a chart or made a single trading decision. This isn't a matter of opinion or trading philosophy. It's simple arithmetic that forms the hidden foundation of market success. The impact of this realization is profound. The trader who makes fewer, more selective trades starts each year with a substantial edge, regardless of market conditions or analytical skill. But the cost goes beyond direct financial impact. Every trade represents a decision point, and every decision carries the possibility of error. The more frequently you enter and exit positions, the more you expose yourself to potential mistakes. This compounding effect explains why those who trade the most often typically achieve the poorest results over time. The irony is striking. The very activity most traders believe will lead to profits is precisely what guarantees their failure. It's as if the market itself is designed to punish impatience and reward those with the discipline to wait. Write in the comments, "Patience is my edge," if you've experienced this trading revelation or are committed to developing this essential skill in your own trading journey. But the mathematical disadvantage is only the beginning of the impatient trader's troubles. Livermore identified an even more destructive element at play: the psychological poison that impatience injects directly into the decision-making process. This toxic mindset creates a devastating emotional cycle that systematically destroys trading accounts. The journey begins innocently enough. The impatient trader enters the market not because their rules have given them a clear signal, but because they're driven by hope. Hope for a quick gain, hope that this time will be different, hope that they've spotted something others have missed. This emotion seems harmless, even positive, but Livermore issued a stark warning. Hope will ruin any man who follows it in the stock market. Behind the scenes, hope isn't the noble emotion we've been led to believe. In trading, it's the telltale signature of gambling rather than professional operation. The moment you find yourself hoping for a particular outcome, you've already abandoned the realm of calculated risk and entered the casino. When a trade based on hope inevitably moves against the trader, as most such trades do, a fascinating psychological transformation occurs. Hope doesn't simply disappear, it mutates into its shadow twin, fear. The trader who bought without a concrete reason now holds without one, watching losses grow larger by the day. Fear paralyzes decision-making, making it impossible to cut losses quickly. The cycle typically ends with the trader selling in panic at the worst possible moment, often near the very bottom of the decline. What makes this revelation particularly powerful is understanding that the very structure of market movements seems designed to exploit this weakness. Markets don't move in straight lines. They pulse, they breathe, they zig and zag. These natural rhythms aren't random. They're perfectly calibrated to shake out the impatient. During strong advances, the market will create sharp, scary-looking reactions lasting a few hours or days. These moves have absolutely no bearing on the main trend, but they're exquisitely designed to frighten impatient traders out of profitable long positions. Just when the weak ends have been cleared out, the main uptrend resumes with renewed vigor. The mirror image occurs in bear markets. Quick, hopeful rallies appear, causing the impatient short seller to cover their position for a small profit. No sooner have they exited than the main downtrend continues its devastating path. These aren't coincidences or random fluctuations. This is the market's natural mechanism for transferring wealth from the impatient to the patient. The hidden truth is that markets don't reward intelligence or information alone. They reward emotional discipline and strategic patience. This explains why some of the smartest people consistently fail at trading, while those with average intelligence but superior emotional control succeed brilliantly. The impact of this understanding creates a complete paradigm shift. What if, instead of fighting these market rhythms, you learned to harmonize with them? What if you recognized these shakeouts not as threats, but as the very opportunities you've been waiting for? If you've ever experienced being shaken out of a position only to watch it move dramatically in your original direction afterward, type "been there" in the comments. It's a universal experience that connects traders across all markets and time frames. One of Livermore's most counterintuitive revelations stems from a practical observation about trader psychology: the danger of watching the market's moment-to-moment movements too closely. In his era, this meant the physical ticker tape. Today, it's the mesmerizing glow of trading screens and real-time charts. The medium has changed, but the psychological trap remains identical. Livermore strongly cautioned against spending too much time observing minute price fluctuations. He discovered it was nearly impossible for anyone, regardless of experience or emotional discipline, to sit surrounded by constant market data, breaking news, and idle speculation without having their judgment compromised. This cognitive distortion happens so subtly that most traders never realize the transformation occurring in their decision-making process. The hidden truth is that the market's minute-by-minute movements are often meaningless noise designed to confuse rather than clarify. Watch any chart long enough and it will make you change your mind repeatedly throughout the day. Livermore observed that 90% of these mind changes will be wrong because they react to minor, ultimately inconsequential moves rather than the true underlying trend. This journey into market psychology reveals something even more fascinating. The tape, or today's equivalent, the chart, isn't merely a neutral reflection of buying and selling. It's a strategic communication tool that sophisticated operators use to broadcast precisely what they want you to believe. Behind the scenes of every major market move is what Livermore called the composite operator, the collection of informed insiders and large interests who understand this game. At its deepest level, when these operators wish to distribute shares at market tops, they deliberately create wild activity and dramatic price swings, making stocks look their strongest precisely when they're most dangerous. The psychological impact is immediate and predictable. The impatient public, fearing they'll miss the move, rushes in to buy, absorbing the exact inventory that smart money is eager to sell. The visual spectacle of rapidly rising prices creates an irresistible fear of missing out that overwhelms rational analysis. Conversely, when these same operators are accumulating at market bottoms, they orchestrate an entirely different performance. They allow stocks to become dull and inactive, creating the appearance of weakness and disinterest. The public, bored by the lack of movement and discouraged by the negative sentiment, sells in disgust or simply moves their attention elsewhere. This, precisely when the patient, informed operators are quietly acquiring their positions at favorable prices. What emerges from these observations is a profound mindset shift. Perhaps the market's visual displays and price movements aren't meant to inform you, but to mislead you. What if the very price action you've been taught to follow is actually designed to make you act against your own best interests? This revelation forces us to reconsider our relationship with market data entirely. The question isn't whether to analyze charts, it's whether we've been looking at them in the wrong way, allowing ourselves to be manipulated by forces that understand human psychology better than we understand ourselves. If you've ever found yourself making impulsive trading decisions while watching price action that you later regretted, type chart hypnosis in the comments. Understanding this phenomenon is the first step toward breaking free from its influence. So how does the patient professional respond to this elaborate game of deception? The transformation begins with a fundamental shift in perspective. While the amateur frantically reacts to every market wiggle, the professional trader stands back, watching the entire performance with detached amusement rather than emotional investment. Don't miss our upcoming deep dives into profitable trading strategies. Subscribe now and join thousands of disciplined traders who are learning to master their emotions and maximize their profits. This mindset revolution represents a completely different approach to market engagement. The patient professional isn't concerned with daily noise or short-term fluctuations. They're not trying to catch every swing or capitalize on every minor move. Their focus remains fixed on something far more significant, the completion of great market campaigns that unfold over much longer time frames. The hidden truth that Livermore discovered is that real market opportunities don't emerge in minutes or hours. The accumulation of large positions at market bottoms or the distribution of shares at market tops requires weeks, months, sometimes even years to complete. These extended campaigns leave footprints that the patient observer can identify if they have the discipline to watch without acting prematurely. While others chase fleeting movements, the professional waits for these massive campaigns to run their course. Their greatest profits don't come from constant activity, but from a handful of well-chosen trades based on prolonged strategic patience, entering positions only after clear evidence that the preparatory work is complete. Now, I want to go even deeper into this topic by examining exactly what the patient professional is waiting for. Livermore's genius wasn't merely in recognizing the importance of patience, it was in developing a systematic methodology for determining when that patience should end and decisive action should begin. The journey toward mastery centers on a crucial insight. Livermore acted only when the market provided clear, rule-based, and historically verifiable signals that a major move was beginning. His patience wasn't a passive state of inactivity, but an active, vigilant observation, a process of waiting for specific conditions to align before committing capital. He viewed market movements through a powerful metaphor that clarifies this process. Livermore saw the market as a great building under construction. Before any significant advance or decline could occur, a lengthy period was required for preparation, for laying the foundation. The larger the potential move, the more extensive the preparatory work needed. It requires time to prepare and lay the foundation for a building, he wrote. The larger the building, the more time required to construct the foundation. It is the same with stocks. The greater the advance or decline, the more time required in preparing for it. This architectural perspective reveals why patience is so essential. The impatient trader rushes onto the construction site while the foundation is still being poured, risking their capital amidst noise and chaos. The patient professional waits for the foundation to be completed and the structure to be proven sound before committing resources. The revelation here is that market preparation follows recognizable patterns that repeat across different eras, instruments, and timeframes. There's an underlying architecture to market movements that transcends the surface-level noise most traders focus on exclusively. If this concept of treating markets like buildings under construction resonates with you, write "foundation first" in the comments section. This architectural perspective might completely change how you view chart patterns and price action. Let's explore what Livermore was specifically watching for, the actual market conditions that signaled the end of patience and the beginning of decisive action. The first and most critical setup he identified was the completion of what he called great zones of accumulation and distribution. Understanding these phases represents a fundamental transformation in how you'll perceive market movements. Accumulation occurs when informed insiders, or what Livermore called the composite operator, quietly acquire large amounts of stock from a disinterested public after a prolonged decline. This behind-the-scenes process often unfolds over many months, sometimes years, and appears on charts as a sideways trading range with a distinctive signature: narrow price fluctuations and relatively low trading volume. During these periods, the stock appears dull, lifeless, and utterly uninteresting to most market participants. News is typically negative, sentiment is pessimistic, and the general public has either sold in disgust or simply forgotten the stock exists. Yet beneath this uninspiring surface, something profound is happening. The foundation for a massive advance is being methodically constructed. The brilliance of Livermore's insight is recognizing that this period of apparent dullness isn't a reason to ignore the stock. It's precisely when the most careful attention should be paid. The patient trader's mission during this phase is not to trade actively within the range, where they'll be whipsawed by meaningless fluctuations, but to watch vigilantly for signs that the accumulation is complete. Distribution represents the mirror image of this process. It occurs at the culmination of a long advance, when the same insiders who accumulated stock at low prices are now methodically selling it to an excited and optimistic public at much higher prices. While accumulation is characterized by narrow ranges and low volume, distribution often features wide, volatile fluctuations and enormous trading activity. The untrained observer mistakes this frenetic activity for strength, believing the wild upward thrusts signal further advances ahead. But the patient professional recognizes this signature pattern for what it truly is: the systematic transfer of stock from strong, informed hands into weak, uninformed ones. Once these preparatory phases conclude, Livermore waited for one additional powerful confirmation: the crossing of old levels. After a stock completes its accumulation phase, the decisive moment arrives when it finally breaks through previous resistance points, established months or even years earlier. This breakthrough represents a profound market revelation. For a stock to overcome these historical barriers, the buying power must be immensely powerful, strong enough to absorb all the residual supply at those levels. When a stock that has been consolidating for months finally punches through into new high territory, it signals not just temporary strength, but the beginning of a potentially massive advance. When stocks establish certain levels over long periods and then cross them, Livermore observed, it is almost a sure sign that they are going to new high or low levels. The patient professional doesn't try to anticipate these breakouts. They wait for them to occur and then act with conviction. If you've ever noticed stocks that seem to explode upward after long periods of sideways movement, type "breakout clarity" in the comments. You've likely witnessed the exact phenomenon Livermore built his fortune upon. Even with these powerful signals of accumulation, completion, and level crossings, Livermore demonstrated an extraordinary level of patience that few traders manage to achieve. His disciplined approach reveals another layer of market wisdom, the concept of waiting for final confirmation before committing full capital. This wasn't excessive caution, but strategic risk management that dramatically improved his probability of success. Livermore outlined what he called the safest buying points, a precise sequence of market events that provided the highest probability entry points. The blueprint he developed represents a remarkable journey into market psychology and crowd behavior that transcends any particular era or instrument. For a buying setup, he waited for a three-stage confirmation. First, he identified a final bottom after a decline, marking the point where selling pressure had been exhausted. Second, he observed the first rally from that bottom, evidence that buyers were stepping in. But the third stage contained the real revelation. He waited for a secondary reaction following that rally. This secondary decline is where the transformation occurs. The critical insight is that this pullback must hold at a level higher than the first bottom, creating what technical analysts now call a higher low. This seemingly simple pattern represents a profound market revelation. The selling pressure that caused the previous decline has been fully absorbed, and buyers are now willing to step in at progressively higher prices. The definite signal to buy, the safest point of entry, comes only when the stock starts to advance again and crosses above the top of the first rally. This sequence confirms three essential truths. The market has proven it can stop declining, it has demonstrated the power to rally, and most importantly, it has exhausted sellers on a secondary test. By patiently waiting for this complete sequence to unfold, the trader isn't predicting a trend change. They're acting on one the market has already confirmed. This approach transforms speculation from a guessing game into a disciplined response to observable evidence. Now, I want to go even deeper into this topic by examining the specific tools Livermore used to identify these precise turning points with mechanical accuracy. Behind the scenes of his legendary market operations were meticulously maintained charts that served as his lens for viewing market action and provided the final trigger signals he waited for. The two most important of these were his 3-day and 9-point swing charts, specialized tracking systems that filtered out market noise and focused exclusively on meaningful moves. These charts weren't designed for prediction in themselves, but served as precise trend confirmation tools. After identifying a stock that had completed its accumulation phase and crossed an important resistance level, the patient trader would watch the 3-day swing chart for the final, immediate signal to enter. The breaking of the last minor top on this chart would be his definitive trigger to commit capital. As long as the stock continued to make higher tops and higher bottoms on this chart, the minor trend was considered up, and he had a rule-based reason to maintain his position. The 9-point swing chart tracked more significant intermediate trends, with reversals much less frequent and therefore carrying greater weight. A major bull move would be defined by a series of higher tops and bottoms on this chart. The first time the stock failed to make a new high and then broke a previous 9-point bottom served as a major warning sign that the intermediate trend was changing. This systematic approach to market timing represents a powerful mindset shift, moving from emotional, hope-based trading to a mechanical, evidence-based methodology. Livermore didn't care what newspapers reported or what rumors circulated. His decisions were based entirely on the market's own observable behavior. If you've noticed how following a systematic approach to entries and exits removes much of the emotional struggle from trading, type system over emotion in the comments. This mindset transformation might be the missing element in your own trading journey, Having explored the technical aspects of Livermore's methodology, we arrive at perhaps the most crucial element of his entire approach, the cultivation of what we might call the professional trading mindset. This internal transformation represents the bridge between knowing what to do and having the discipline to actually do it. It's the hidden dimension that separates the master from the chronic loser who, despite knowing all the rules, can never bring themselves to follow them. The foundation of this master mindset is something both profound and radical, the complete elimination of hope and fear from the trading process. Livermore was absolutely unequivocal on this point, stating with characteristic bluntness, "Hope will ruin any man who follows it in the stock market. To succeed, you must face facts, and facts are often cold and stubborn." This psychological revolution begins with recognizing that hope isn't the positive emotion we've been conditioned to believe. It's actually the gambler's emotional fuel. It's what drives traders to average, down on losing positions, to hold bad trades long after rules have signaled an exit, and to enter markets without definite cause. The average trader buys a stock and simply hopes it will go up, having no concrete rule-based reason for the trade. The patient professional inhabits an entirely different psychological universe. They don't need hope because their actions are based on knowledge and rules. They've patiently waited for a definite signal, the completion of accumulation, the crossing of an old high, the confirmation of a secondary bottom. Their entry isn't a hopeful guess, but the logical execution of a predefined plan. Once in a trade, they immediately place a stop-loss order to protect their capital. With risk mathematically defined and limited, fear has no opportunity to take hold. The outcome is now in the market's hands. If right, their plan allows profits to run. If wrong, their stop-loss ensures a small, manageable loss. This state of calm, professional detachment isn't some innate personality trait. It's the direct result of diligent preparation. Speculation is a business, and like any successful enterprise, it requires a detailed plan created well before the market opens. Patience is born from preparation. Now, I want to go even deeper into this topic by exploring one of the most counterintuitive yet powerful aspects of Livermore's approach to patience: the discipline of being out of the market entirely. This revelation directly challenges the common belief that a trader must always have a position to be considered active. Livermore discovered that the greatest profits come to those with the patience to remain on the sidelines in cash, waiting for truly exceptional, high-probability opportunities that might appear only a few times each year. His advice was crystal clear: when in doubt, get out, and don't get in when in doubt. The wisdom behind this approach is profound. A trader who is perpetually in the market inevitably develops warped judgment. It's human nature to interpret news and market action through the lens of one's own position. If you're long, you unconsciously give more weight to bullish factors. If you're short, bearish information seems more significant. Clear, impartial judgment only becomes possible when you have no financial stake in the immediate outcome. For this reason, Livermore advocated taking regular breaks from the market, completely closing all positions at least twice yearly to allow the mind to rest and judgment to clear. If you've ever experienced how being out of the market entirely creates a strange sense of clarity about price movements that seem confusing when you had money at risk, type "clarity through distance" in the comments. This counterintuitive insight might be the missing piece in your trading evolution. In many ways, Livermore's insights on patience represent a complete paradigm shift in how we approach the markets. While the world glorifies action, urgency, and constant engagement, the master trader understands a deeper truth. Strategic inaction, disciplined waiting, and selective participation are the real keys to sustainable success. The market will always be there tomorrow. Opportunities aren't scarce resources that vanish forever if missed. They're cyclical phenomena that consistently return for those patient enough to wait for them. The real skill isn't in finding more trades, but in having the discipline to wait for only the highest probability setups. If you found value in these insights about the power of patience, I'd love for you to join us on this journey of trading mastery. Hit that subscribe button to continue exploring these timeless principles that transformed Livermore from an average operator into one of history's greatest market legends. Did something in this video particularly resonate with your own trading experience? Leave a comment with the phrase, "Patience is power," and share which specific insight struck you most deeply. Your perspective might be exactly what another trader needs to hear. If you found this exploration valuable, giving the video a like helps tremendously in sharing these ideas with others walking the same path. The trading journey can be isolating, and creating this community of thoughtful, patient traders is something I'm passionate about. Right next to this video, you'll find another exploration of Livermore's most powerful trading principles that builds perfectly on what we've discussed today. Click on it when you're ready to continue deepening your understanding of the patient professional's approach to the markets. The journey of mastery is just beginning.